Welcome to this explainer. Today, we're diving headfirst into one of the most fascinating and frankly brutal clashes in the financial markets. That relentless battle between your logical strategy and raw human emotion. Let's be real for a second. If you've ever stared at a live chart and felt your pulse spike, you know exactly what we're dealing with today. We're exploring the psychology of trading, and more specifically, how our emotions can completely hijack our strategy, our risk control, and our better judgment.
So here's the ultimate market mystery. Two traders can be looking at the exact same chart. They can use the exact same strategy, trigger the exact same entry price, and yet they finish the session with completely different results. Why? Well, it's usually not a lack of market knowledge. The real wild card is what goes down inside our heads when money, uncertainty, and hope all collide at the exact same time. Trading is basically the ultimate real-time test of your decision-making.
Okay, let's dive into this. Here is our roadmap for the explainer. First, we'll uncover the emotional trading trap. Next, we'll take a deep look inside the greed mindset, followed by its dark twin, the fear mindset. And then finally, we'll lay out the process-based solution so you can reclaim your discipline. Let's start with section 1, the emotional trading trap. Basically, when emotion completely overrides your strategy. If you've been in the trenches, you know this feeling intimately. Your trading plan makes total, perfect sense when the market is closed, right? The logic is flawless, but the absolute second you're in a live trade, the price starts violently taking up and down, and suddenly fear, excitement, regret, and this overwhelming need to just be right completely flood your system. Look, these emotions are totally normal, but the danger hits when they quietly sneak in and completely overwrite your original plan.
So how does a logical plan go off the rails? It happens through the emotional trading cycle. It always starts innocently enough. Step 1, you get a market signal. Step 2, you build this expectation of what the market should do. But then the market moves, and step 3 hits, a massive emotional trigger. That emotion pushes you right into step 4, some impulsive action that was definitely not in your rulebook. Step 5 hands you a result, maybe a profit, maybe a loss, which then feeds directly into step 6, leaving you with an even stronger, messier bias for your very next trade. It's a vicious loop that turns logic into pure chaos.
And this brilliantly illustrates how that cycle pushes us toward two incredibly dangerous extremes. Notice the contrast here. The greedy mindset, it's hyper-focused purely on what could be gained. It totally underestimates risk and just blindly chases movement. On the flip side, the fearful mindset focuses entirely on what could be lost, bailing out early and completely avoiding perfectly valid setups. But here is the crazy part. Greed and fear aren't actually opposites in practice. They both bubble up from the exact same toxic source, a desperate attachment to an outcome. Greed screams, I absolutely must make more, while fear whispers, I cannot afford to lose. Moving right along, let's unpack section 2, inside the greed mindset, or the illusion of confidence. Now, greed gets a bit misunderstood. It isn't just about wanting a shiny new car. In trading, greed is that specific, dangerous split second when the mere possibility of profit suddenly outweighs the rigid rules you built to protect your capital. And the tricky thing? It rarely feels like greed. Usually, it just feels like extreme confidence, intense urgency, or this gut feeling that you're staring at a once-in-a-lifetime can't-miss setup. The most common flavor of this greed is FOMO, the fear of missing out. Put yourself in his hot seat. You're watching a super fast-moving market. Social media is going crazy celebrating profits. The chart is just going parabolic. And you feel this literal, visceral pressure in your chest, screaming that you have to get in right now. So you hit buy after a massive extended move. You aren't entering because you have a valid setup. You're just entering because you can't stomach the idea of everyone else making money without you. You're entirely fixated on how much can I make and completely forgetting to ask, wait, what happens if I'm wrong? Then there's the massive trap of overconfidence after a winning streak. This is when your brain plays a brutal trick on you. You string together 3 or 4 wins, and suddenly you think your skill level has gone through the roof. You mistake random market luck for sheer, undeniable mastery. And what happens next? Your position sizing balloons. Your filters for taking a trade just evaporate. You start overtrading, treating pure frantic activity as productivity. Ultimately, this just leads to fatigue and impulsive nightmares, like revenge trading just to prove to the market that you're right. Now, if you're sitting there thinking high activity means high performance, the data tells a very different story. Historical brokerage data actually reveals a massive performance cost to hyperfrequent retail trading. To put that into perspective, one major study showed that the most active households earned markedly lower net returns than the broader, boring market. The takeaway here isn't that active trading is impossible. It's that supreme confidence and immense activity are absolutely entirely different from actually having a mathematical edge.
All right, let's flip the coin and head into section 3, inside the fear mindset and the cost of avoiding pain. Listen, fear is basically just biology at work. It's your brain's primal attempt to avoid pain. Now, a healthy respect for risk, that keeps you in the game. But unmanaged fear, that creates a trader who is inconsistent, perpetually late to the party, and totally self-defeating. When fear takes the wheel, your mind is constantly scanning for threats. It gives negative information way too much weight until totally normal market chop starts feeling like absolute proof that the sky is falling and your trade is doomed.
Now, what's really interesting about this is the concept of loss aversion. As human beings, we are wired to react significantly stronger to losses than to equivalent gains. Because losing $100 hurts way more than winning $100 feels good, a tiny planned paper cut of a loss suddenly feels completely unacceptable to a scared trader. This fundamentally breaks you, encouraging you to desperately delay a totally necessary exit. You widen your stop loss, or worse, you delete it completely, because taking the L feels worse than carrying the risk. And just like that, a planned paper cut turns into a completely catastrophic loss. And this leads us to this wild psychological paradox known as the disposition effect. It's the ultimate hidden trap of fear. Think about it. A trader will panic sell a beautiful winning position way too early just to lock in that sweet, sweet emotional relief of a win. But that exact same trader will hold on to a dying, losing position forever, just hoping and praying it bounces back to break even so they can avoid the pain of admitting defeat. It looks completely contradictory, right? Early exits on the winners, late exits on the losers. But the underlying protective emotion driving both is exactly the same: fear. And when you mix all this together, you get this brutal snowball effect, the fear to greed loop. Track this escalating cycle with me. Stage 1, you take a standard loss. That sparks stage 2, fear and hesitation. You want perfect certainty before you trade again. Well, because you hesitated, stage 3 hits. You totally miss the next perfectly valid, profitable move. Missing it triggers stage 4, intense FOMO and pure greed. You can't take the pain of sitting on the sidelines anymore, so you jump in blindly, leading directly to stage 5, a terrible late entry and inevitably a brand new loss. And the whole thing starts over. So, how in the world do we break this cycle? That brings us to section 4, the process-based solution, or how to finally reclaim your discipline. Look, let's get one thing straight. The goal here is absolutely not to become some emotionless, cold-blooded robot. That's a myth. The real goal is just building a system that prevents a temporary emotional spike from changing your position size, your entry rules, or your risk limits. True discipline is simply saying, I feel the emotion, but I'm going to follow the process and accept the uncertainty anyway. So, the crucial point is putting a concrete psychological risk framework into action. First, you have to completely define your setup before the session even starts. Know your entry, your stop, your targets. Second, and honestly this is a game changer, choose your position size based strictly on what you can afford to lose without losing your mind, not the amount you're fantasizing about gaining. Third, use a physical, written checklist. That way the adrenaline of the moment can't quietly override your rules. And fourth, you absolutely must set hard daily loss limits and maximum trade counts. When you hit them, you literally close the laptop and walk away. Continuing with that framework, you have to enforce a pause after any major win or major loss. The emotional intensity of those moments heavily distorts whatever decision you make next. Next up, when you journal your trades, write down the decision process, not just the dollar amount. Ask yourself, did I actually follow my exit rule? Also, if you're feeling unstable or nervous, reduce your position size. Dropping your risk literally lowers your blood pressure, making it so much easier to just execute your plan. Finally, judge yourself over a meaningful sample size of 20 or 30 trades, never just one random outcome. Let's move to the next part and see how this builds into an awesome, actionable tool you can use the exact second market pressure hits. I call it the 3-question reset. Right in the heat of a live trade, you pause and ask yourself, 1. What am I feeling right now? Literally say it out loud. Is it urgency, greed, panic? 2. What does the plan actually say? Force your brain back to objective reality, like where your invalidation point is. And 3. What action protects the process?
Base your very next move, whether that's holding, selling, or doing literally nothing, entirely on the plan, not the racing in your chest.
Ultimately, to be a professional, you don't need a crystal ball to predict every single tick of the market. You just need a repeatable process for acting responsibly when you have no idea what's going to happen next. The market tests your strategy for sure, but more than anything, it reveals your character under pressure. Greed is always going to ask you for more. Fear is always going to beg you for safety. But discipline just asks for the plan. So I'll leave you with this thought. The very next time you sit down at your desk, will you be trading the market or will your emotions be trading you?